Well, good evening and welcome to this live stream event on the 17th of September 2019. It's Martin North here. This is the pre-show bit, so we'll just talk a little bit while people come on. Notice the interesting conversation. Somebody asked me about my favourite beer. Actually, I don't drink. Not even beer. So there you go. Good to see so many on, and very interesting to see some of the pre-discussion. That's one of the reasons why we let the stream run a bit ahead of time, so that people can get into the swing, as it were, and like to say that there's some really interesting conversations going on there. Yeah, I think, the whole question of civil liberties, the whole question of how close we are to a conflict, I think these are very important questions. And, I've lived through a few different issues over my life, but I think the way that the world is at the moment is quite concerning, I have to say. Never mind, we'll try and keep a sense of balance in our conversation today. Now, I'm not going to say hi to everybody on the channel simply because there are so many, but Kay from New Zealand, nice to see you on. And from Tel Aviv, I think somebody there by the look of it. Neil, not drinking beer is un-Australian. Yeah, I know, I'm sorry, but never have. Oh, I come from the UK in any case. We prefer tea, Interesting, of course, also the reaction to the cash ban and our post earlier today, and we'll touch that a bit later as well. I need an Indiana Jones hat and whip, and that's an interesting thought. Yeah, I'm not sure about the whip, but maybe the hat. It's actually very interesting. The last couple of weeks, of course, has been very interesting, partly because of the AFR and what they did, partly because of where we are with the cash ban, and partly where we are with the latest on property prices. So a lot to talk about tonight. I thought of wearing my khaki shirt again tonight, just for Mr. Patrick's benefit, but I decided to go with a slightly different outfit. And by the way, I'm wearing a jacket because it's blooming cold here in Sydney. It's been raining all day, and it is very, very cold. Moi, hello from Linfield. Good to see you. Okay, I'm just going to run this for another 30 seconds and then we'll get going and get the show on the road, hopefully. From Canberra, hello Paula, good to see you. A lot of interesting points being made there. Yeah, I don't know how many, where you got the 14K from, but 34,000 submissions on the cash ban from an insider. May well be more, but we may never see many of them, I suspect. It's pretty interesting, isn't it? So if you from the AFR press 1, I like that. Very good. Okay, so let's get going. I'm just going to switch across and run the normal introduction, and then I'll be back, and hopefully we'll start the show formally. Just stand by. Well, good evening and welcome to the live stream event on the 17th of December 2019. Good to have you on board, and welcome to a rather cold and chilly windy evening in Sydney. Martin North from Digital Finance Analytics here. I'll be your host for the next hour and a half or so, and looking forward to having an interesting set of discussions with you with regard to property, finance, and all things related. Plenty to talk about. It's very interesting to see some of the comments already on the channel, and we've got a good number on already. I'm sure there'll be a few more coming. It's always a few late starters, but great to see you all on board with me. And, if you've got questions, then I'll be very happy to take those a bit later. As is my normal mode of engagement, I'm going to start by essentially looking at a few slides just to set the context, and very importantly to give you some ideas perhaps for additional questions. I have a bunch of questions already from people who sent them through beforehand. In fact, I've had several hundred questions and comments quite recently. And so what I've done is to crystallize those into some areas. So if somebody asks me a question, I'll answer that particular area. If not, towards the end of the show, I'll bring some of those back to the table myself, all being well. So that's the plan. And without further ado, I'm going to now switch across and we'll start the next part of the show. And as I say, that will be just a few introductory slides. And from then what we can do is take questions a little bit later. So I'm not looking now at the questions at this time. So if you have specific questions that you'd like to ask me, just hold off until I've gone through the next few slides, and then we'll go on from there. So just in terms of what we're doing, we start with this introduction. I'm going to touch on some house rules just briefly. I'm going to talk about our models. I always do, just so you understand that this is not something I make up. This is all about analytics and how we construct our thinking. I'll then just run through a few key slides. Then there'll be some questions and answers, and that'll be typically an hour or so, I guess, or maybe slightly longer. And then we'll sign off, and typically the whole show runs for about an hour and a half, plus or minus. So in terms of the house rules, just as always, I have to say this is not financial advice. I'm not qualified to give financial advice. And please don't take it as, I don't know your individual circumstances, but I do a lot of research and analysis and talk to a lot of people. So I'll be able to talk generally about what's going on, but this is not financial advice, and please don't take it as such. Second thing, please play nice in the chat room. No racial slurs. We have had a few issues in the past. Joe Wilkes, I think, is on the channel, and he'll be helping to moderate what's going on. So if there are any nasties, we'll chop them out hopefully very quickly. We try not to ban people, but we have banned a few over the recent months. So if you want to have a good conversation, you don't need to do slurs. There's a really, really good community around DFA now, and we have 27,000 subscribers and a lot more watching a lot of our shows, and the quality of the discussion is remarkably high. So I hope we can benefit from that this evening. Should say this is as at the 17th of September 2019. If you're watching this later, things may have changed. You'll be able to tell whether I was right or whether I was wrong, I guess, but this is as at today. If you want to get my attention through this evening, if you could use @WalkTheWorld, that's my handle, and that will enable me to catch quickly your questions or comments. There's always a lot of other chats going on the channel, and I don't have time necessarily to look at all of them, but if you use @WalkTheWorld, then you've got a good chance of getting my attention. We also do have Super Chat enabled, and that means that if you want to ask a specific question, or indeed even make a donation to help fund the channel, you can use Super Chat, and that is pretty straightforward. Essentially, by paying a small amount of money, that goes to the DFA channel, and it also means that your question goes right to the top of the list and persists on the channel for a significant amount of time. And I always try and acknowledge those particular questions and contributions specifically. So just in terms of the core market model, this is the way it works. We have all our surveys running, 52,000. We capture information from many other sources. We put them into our core market model. That is where we do our analysis and our scenarios, and that then feeds our mortgage industry reports and all the stuff that goes on the DFA channels and Interest of the People channels, and also custom work for clients as well. And that model has been running since 2002, so it's proved to be quite robust, and we try to incorporate all of the various elements that are involved in looking at how the industry is running, look at how the market is running, and looking at how households are running. And we overlay our segmentation so we can slice and dice the data in terms of, for example, property activity, location, and even master segmentation, so we can see what's going on with different types of households in different locations. Now, just in terms of a few key slides. This is just from the Reserve Bank minutes today. As always, we do this on a Tuesday because this particular Tuesday each month is when the RBA puts their minutes out. And frankly, you could almost assume it was last month's minutes with just the heading change. But there were a few things that were really interesting. The first one was they did recognise that retail sales volumes had dropped considerably. And also the low and middle income tax offset, the LMI, ITO, was expected to boost household income, but they're suggesting that perhaps it hasn't. In fact, that confirms information that we've seen from some other surveys and our own surveys, that many people, if they did get a tax refund, it's a lot smaller than they thought, firstly, and secondly, they're saving it or they're paying down their mortgage rather than spending it. So if this was meant to stimulate the economy, so far it's a fail. The other point, of course, is that they refer again to dwelling investments, particularly construction and new construction. Approvals are down yet again, and what that means is that there is a very little chance of the construction sector rebounding anytime soon, and our own view is that this will actually continue for quite some time. Wages growth, of course, has been low, but now they admitted also in their minutes this time that it looks as though wages growth has stalled. And that is, again, consistent with our own analysis and surveys. Many people have said that in real terms they've seen no increases at all. And in fact, statistically speaking, most households in real terms have seen no increase since 2009. And, the bottom line is we expect more cash rate cuts, probably October or November. Westpac came out today and said probably October. NAB, in fact, suggests that maybe 3 rate cuts down to 0.25% by the middle of next year. So we're in a cutting cycle, and we'll talk about the implications of that a little bit later. Now, also today, the ANZ Roy Morgan Consumer Index came out and fell 3.5% from the previous week. This is an amazing dip, and it's the lowest level of confidence in 2 years. And frankly, this looks like being consistent with our own surveys that we've been tracking consumer sentiment weakening. And there was a little bit of a rise earlier on around the election. The Conservatives got in, and that was probably positive relative to the other side. But since then, things have not gone well. The rate cuts have probably not been interpreted very positive. The international news is very weak. And as a result of that, it's definitely an issue. Jody, thanks very much. Appreciate your contribution. I'll go to help make more content for you. So the confidence index from ANZ today, very, very weak. And I think this is another forward indicator of trouble ahead. Mortgage defaults were reported. This is from the S&P Global Ratings. The headline was that the mortgage defaults dropped slightly. The 1.49 was slightly better than last month. But within the numbers, 2 points. Firstly, in New South Wales, defaults went up this month, and that's something we've been consistently seeing now in our own surveys, that the pressure on households, particularly in New South Wales, are really rising. And of course, it's the most populous state, so if a lot of people in New South Wales have issues, not surprisingly, that's going to have an impact more broadly on the economy. The other point to make is that whilst the overall number was just slightly down, the 90-day plus defaults was up. It was actually up from 0.81% in June to 0.82% in July. And this is again consistent with our analysis that longer term households are getting into difficulty and staying there longer, consistent with our mortgage stress, which is higher, more than 1 million households in mortgage stress. So the story of mortgage defaults is a worrying one, remembering that interest rates have never been so low. And this is the thing that people keep forgetting, when they say, well, it's all very well, not an issue. Well, how is it that we've got such high level of mortgage defaults when interest rates are so low? The answer is people have big mortgages and people have flat incomes and rising costs. And that all, of course, has come through in terms of our surveys. Now, the ABS also published their residential property price indices today. Now, this is till June. And, of course, you could argue this is all late news because since then, we've had a couple of rate cuts and the core logic index is now pointing up. But until June, they said that in the June quarter, overall prices fell 0.7%. Melbourne was down 0.8%, Sydney down 0.5%, and all capital cities apart from Hobart recorded the full. Hobart was up 0.5% and Canberra up 0.2%. What's fascinating here is that if you look back over the last year, property prices over the last year has fallen 7.4% in the June quarter, with 9.6% in Sydney, 9.3% in Melbourne, but Hobart was up 2%, and that's the only capital city to record positive growth through the year. And then the last point to make from the ABS is that the total value of Australia's 10.3 million residential dwellings fell by $17.6 billion. And that is another fall. So essentially, the value of residential dwellings have fallen for 5 consecutive quarters. And this is the negative wealth effect in action, right? So overall, people are feeling less wealthy because the property values have fallen. And it's worth saying, there are maybe some indications of some moves up, but our analysis is suggesting those moves are not very uniform, and quite a few locations, property prices are still well down. Now, this is now just the tracker, if you like, and it's looking at the annual percentage changes by city. It's quite a busy slide, but you can see that generally prices have been sliding since 2008. Of course, we've had those unnatural acts now. We've had rate cuts. We've had the APRA loosening. We've had the banks releasing some additional funds, the lending standards probably loosening as well, and also cutting rates to try and attract new borrowers. So no surprise to see that the credit impulse is just beginning to turn up a little. And as you may know, as I keep arguing, the rate of change of credit is directly correlated to what happens to house prices. On the basis of that, we expect house prices to continue to move up for a little while. But the question is how consistently and how long, and what happens next. Now, CoreLogic said the top end of the market is recovering the fastest. This is data they've published very recently, and they've split it by the lower, middle and upper quartiles. And you can see there that it's the upper quartiles that are moving up. That's pretty consistent with what we've seen in previous recoveries, where the top of the market, people with more access to finance and more access to funds, tend to buy first. But nevertheless, we're also seeing that there are some very different dynamics in play in other regions and other locations and other types of property. And further down the market, we are definitely seeing significant pressure, much lower levels of recovery, off the plan, for example, recent high-rise constructions that people have bought, and a bunch of other stuff too. So the point to make here is that these average indices, which are published and, frankly, the media just goes to town on them, tell you very little. You need to actually get very granular and go into individual postcodes. And in fact, I'll be posting an interview I did with Chris, forgotten his surname, with Chris Bates tomorrow. He's our mortgage broker and finance advisor, and we're going to talk there specifically about need to get granular and what's happening in different segments of the property markets, because his argument is there are definitely some movements in some locations, but those are quite specific locations with certain characteristics. More broadly, the markets are not behaving the same way, and so we shouldn't be deceived by these average rate moves. So just remind you also about how I think about house prices. Now, clearly you can go price discovery. In other words, you run an auction or you see what people will offer. And that's one way of thinking about house prices, but it's not necessarily the best way, because the other way to do it is to think about building up from land utilities and fees, from construction costs and inputs, and the amenity value, for example, somebody has a wonderful view or whatever else. And if you build up the costs of property in Australia using those particular building blocks rather than price discovery, we are still 40% overvalued relative to what it should be. And that's one of the reasons why I say that ultimately there is always a risk that we're going to come back to a pretty fundamental correction in property values towards something which is more like the real value of property. Now, it may not happen immediately, but there's always that risk. And that's one of the reasons why I come back to my 40%. And, I've been challenged a few times as, you see you're wrong, prices are moving up again. Well, just wait and see, I've always said it'll take a long time to play out. But this fundamental point about where value is really important, because price discovery is insensitive to the true value of land, building and amenity. And that's the problem. And just lastly, bonds. It's worth looking at bonds because they're giving some very important signals around the world. Essentially, we are seeing rates going even lower. In other words, people are prepared to take bonds, buy a bond, even as a loss, because they want to guarantee a future return. And that is one of the reasons why we are quite concerned about what's happening internationally. The bond markets and what's happening with those bonds and the very low rates are indicative of lower rates across the board later, and also the fact that people are prepared to forgo returns in certainty of getting the money back when the bond is recovered, down the track, and it could be many years down the track. And there are people around the world buying bonds with negative yields, holding it for 10, 30, or even 50 years. That's a remarkable situation, and yet investors seem prepared to do that. That tells you that many people around the world are worried about the way that the financial system is looking at the moment. Now, just in terms of our scenarios, we drive that off our core market model, as you'll perhaps know, and our scenarios try to give you a bit of a flavour of some of the ways that we think about where prices could go. This is because I have never definitively said prices will definitely do X or Y. What I've tried to do is to paint a range of pictures, talk about some of the circumstances that might lead us to those end results, and then give some relative weightings. But, I'm just giving you some different scenarios based on the models. I'm not saying that any particular one is right. And it's a way of thinking about the future. It's a way of trying to give a way of talking about things without necessarily being absolutely definitively anchored to one outcome. And that's important because there are so many variables in this. Adrian, thank you very much for your contribution there. Really appreciate it. That's tremendous. Certainly help us to continue to make more content. So the way we do this is we have our scenarios, business as usual, which is based off what the RBA is saying with a view as to what may or may not really be likely to happen. Things are going to get better, which is a slightly, if you like, worse scenario. There, we're assuming that essentially the issues are going to be more difficult than perhaps might think. And we can talk about some of those in a second. Not yet doomsday, another slightly more severe scenario. Armageddon, which is effectively when banks get bailed out, a la Ireland, or doomsday, when banks fail and don't get bailed out, which is what happened in Iceland. So that's essentially the way we do it. Thanks, John. Appreciate the coffee. And somebody else also made a comment there as well. Yes, thank you. Piston, thank you for that. We'll talk about hyperinflation in a second because it's absolutely one of the scenarios. Devaluation of assets, etc. Those things could definitely happen later. The real value of assets, that is. Anyway, let me just go back to my slides there. So in my first scenario, this is basically if the RBA is right. Now they're talking about unemployment in the next couple of years going to 4.5%, and at 4.5%, we might see some rise in wages growth, but I don't think they're going to get to 4.5%. So I'm believing that 18 months, 2 years from now, and I should say that we're building our base case from a year ago in this model. So this is effectively looking ahead. Unemployment rate 5%, mortgage stress around where it is now at 32%. The bank losses slightly higher than today, but home prices ahead somewhere between 5 and 8%. And there'll be easing, there'll be QE, all of those things. The home price path here is that there is a path potentially to some lifts of house prices if in fact the Reserve Bank is right and if in fact everything else is effectively plays out as they think without any interference from international issues, without any major disruptions like oil or anything else. Now that today has a 14% probability rating on it. Now, it went up from 10% last time. So there is still a chance that this will play out the way the Reserve Bank is portraying it. But I have my doubts as to whether it will actually make it or not. Now, the next one is things going to get better. Now, here, effectively, the Reserve Bank has to cut further. And, of course, I said that NAB was predicting a rate down to 0.25%, so it's not unheard of. That's why I put it in there. Unemployment, though, is going to rise. And it's going to rise because of retail. It's going to rise because of jobs in the construction sector disappearing. The knock-on effects of that means that effectively more people will be struggling to pay those mortgages. Mortgage stress goes up to 36%. Many more people get into difficulty. The bank losses rise. And this effectively means that home prices aren't going to move up over the sort of 2-year period. They might go up a little way, but then they'll start sliding again. And it's interesting, if you look at what happened in Ireland, there were actually 3 mini recoveries before property prices ended up 40% down over 2 or 3 years. So I think we're potentially in one of these slight up, then down, up, then down trends. And so we still think that in this time frame, over the next 18 months, 2 years, -5 to -10% down. And credit easing, more fiscal stimulus, trying to get people to spend. I'm expecting to see helicopter money and those sorts of things in this scenario. In other words, people trying to be encouraged to spend. The cash ban may also be an element here, because essentially one way to force people to spend is to make it less easy to hold money. And even if you get very low or nothing on deposits, you might be more willing to spend. That's the theory that some of the bankers have. I think it's rather unfair, but that's what they're saying. Now, the next one is not yet doomsday. This is now more severe. So essentially we have rates right down at 0.25%. But now the broader knock-on effects here are not only just local, but now we're starting to see some of those international things coming in. I'm thinking of China weakening. Maybe the trade war with the US doesn't get sorted out. Maybe China's economy, which as they already said, may now grow below 6%, may already be below 6%. China has been stimulating its own economy dramatically. It's been lowering its capital ratios for its local banks to try and actually encourage them to lend more. It's trying to get consumers to consume more in China. If that doesn't work, China could be an issue. We've got Brexit, of course, and that might all blow up with Europe. And then we've got what happens in the US. And a lot of people are still predicting that in the US there could be a recession in the US in 2020. As we discussed at the weekend in our Property Imperative post, there are lots of contradictory signs there. But consumers are not necessarily doing what people want them to do. And of course, we've got big corporate debt. And one of the big questions in the US is the zombie companies, those who borrow heavily, share buybacks, but essentially have not really got a growth strategy for their business. So those are some of the things that are coming in over the top now. In this scenario, property prices would likely drop 15 to 25%. And in that scenario, one bank could well need to be bailed out if it's to survive. And that now has a 20% probability, the same as last month. So you can see that there is, if you add those together, 30, 50, 64%. So more than half of my scenarios are in that range. And that tells you that, it isn't all doom and gloom, but some of this is looking pretty wobbly. But then if you take it further, and then we go to the Armageddon scenario, and this is basically now where banks start to get into difficulty. The international situation gets significantly worse. The liquidity that is currently available and required to support the $1 trillion of international debt that we've got in Australia, a lot of that related to the banks, of course, that all freezes up. And in that situation, interest rates will be cut to zero or maybe even below. Unemployment rate will continue to rise higher, and the mortgage stress levels will be very significant. The bank losses would now be dramatically high, to the point where the banks would probably need to be bailed in or bailed out. And that's when you start thinking about deposit bail-in. That's when you start thinking about bank reconstruction and all those sorts of things, bail-in and bail-out. And in that scenario, home prices could certainly drop 30 to 45% down. And again, this is now in a scenario that says we get back to more fundamental values of property, showing you, remember in that slide I showed you before, where we get back to more fundamental values. So that's why 30 to 45 is sort of not completely impossible. And in fact, if you compare it with what happened in Ireland or in areas of the US, similar things happened post the GFC. We never had that correction here, of course. And that has a 35% weighting. So that's pretty significant and important. And then the last one is Iceland 2.0. Now here, you basically have interest rates at zero or below. It's very high unemployment rate, very high levels of mortgage stress, very high levels of bank losses. Home prices drop dramatically, and banks are allowed to fail. And that's the fundamental catalyst for this model. Now, the reason I've dropped this rating down to 1% is I don't think there is any intention amongst central banks around the world to allow banks to fail. And there is an implicit guarantee, I think, that by hook or by crook, by bail-in or by bail-out, or by restructuring a bank, or by putting more capital in some way, the intention is that they will manage a bank's demise through other means rather than a failure. And so that's why that is now rated very, very low. Now, it doesn't mean it's not necessarily going to happen, but it It's very low probability. So you can see there, if you sort of stand back and just look at my overall scenarios, what I'm actually saying is that there is a reasonable probability that we will see small falls in home prices over the next couple of years. That those won't be uniform. Probably some areas of Sydney and Melbourne will fall dramatically more. High rise I'm very concerned about, and the data that I'm seeing at the moment is that many people are now worried about the value of the property that they're in if they're in a high rise, especially a new one or a relatively new one. We've also got land packages on the suburban fringes where people bought 18 months, 2 years ago at the peak, and they're still underwater. And you may have seen my post from the other day when I actually made the point that around 11% of households are currently classed as subprime on my modelling, meaning that a lot of them are in negative equity at the moment. So it's a big deal. So there we are. That's my scenarios at the moment. Some minor changes from last month, some minor changes in the probabilities. And just to reiterate, these are all live scenarios at the moment. So property prices could go higher, they could go sideways, they could go lower. And the reason why it's hard to predict precisely how this is going to play out is there are too many variables, too many moving parts, and too many external factors that could well influence. My own view is I think we've been shown through the Reserve Bank, through the government and through APRA, a strong willingness of the regulators in Australia to do whatever it takes to try and support the property market. And that's why the business as usual scenario is now up to 14%. Okay, so I hope that was of some use. What I'm now going to do is to come back to the Q&A section, and we'll take a look at the questions that have been asked, and we'll go on from there. Just have a quick skip back through and see what I missed, and from then we can start answering some of the questions that you've asked me. Okay, so Machine asks, what if the government goes after flooding the market with more migrants? Will that have an impact on houses? Yes, absolutely. So what is not understood, I think, in Australia is that we've had a form of quantitative easing for about 2 decades. All right? But that quantitative easing is actually people. Because what we've actually done is we've inflated the number of people in the country. And so on a GDP per capita basis, we've been going backward for at least a couple of years. And before that, it was pretty marginal. But when you actually add in the extra people, what that does is that inflates the overall size of the economy. And because we keep bringing people in, that essentially gives the economy a more positive spin than it would otherwise be. So that's why I'm calling it quantitative easing, because essentially what you're doing is you're basically flooding the economy with more people. And that is still going on. So the latest migration statistics were extremely high. And so far as I can see, there is no real intent to dial that back, despite the fact that some states are now saying that they're full and that they're struggling with the population growth, and despite the fact that if you drive around some of the major centres in a rush hour, you'll know just how bad it is relative to 15 or 20 years ago. Now, how does this play out then in terms of the property market? Well, 2 things to say. Firstly, we know that there is still a lot of vacant property around. The census a couple of years ago showed that there were more than 1 million properties vacant across Australia. And we also know that there are about 220 to 270,000 new construct underway at the moment, this year, next year. So there is a supply of property more than sufficient to meet the demand from the migrants who are coming in. Now, some of those might be in the wrong place, so the locations might be out of whack. But in terms of the pure numbers, we do not have a property supply shortage. That's one of the myths that's been propagated by the construction sector, by the governments, by the state governments. Now, the state governments, of course, love the large property sector, particularly the taxes that are paid, stamp duty and construction taxes on new property. So it's been a very important source of revenue. And in fact, pretty much all the states who have stamp duty are reporting lower levels of stamp duty than previously. That's making a hole in their budgets. So they're keen for that to continue to happen. The other point to make is that a lot of those people who come in, the migrants who come in, some of them may have the wherewithal to buy property, but many don't. So quite a few of them will be living with friends or family who are already here or maybe renting first. So it changes the dynamic also, not just in the construction of new property or the sale of existing property, but also in the rental sector too. And that's one of the interesting observations. You look at rentals, both in Sydney and Melbourne, there is more supply now than there was previously, and the rentals are actually sliding. In fact, in Sydney, they're down quite considerably. Now, if it was true that there was an undersupply of rental property, you'd expect rentals to rise much more firmly than they are. But the average rents are falling. Two reasons. One is there is a greater supply of property, firstly. And secondly, rentals are much more linked to income growth than property values. And what that means is that people are unable to pay more for that particular accommodation. In fact, there's a lot of evidence from my surveys that people in rented accommodation are looking to move to cheaper areas and particularly out-of-town areas to be able to pay less for their accommodation. So I think it's not as simple as saying that this massive migration of people into the economy will drive prices higher. I know it's one of the arguments that's used by a lot of people, but in my own modelling, I believe there's more than enough capacity in the housing sector in most major centres to be able to actually counteract any growth from migration. So I don't believe the myth that we need to build a whole lot more properties. And by the way, it's same in New Zealand. Joe Wilkes and I discussed this quite recently. In New Zealand, there's been a massive construction boom. And now, of course, what we're finding there is that, particularly in around Auckland, prices are actually beginning to slide simply because the equation doesn't work. Okay, let's go to the next one. This is from Joseph Wilkes. What we are seeing, he says, is a flight to quality. That's why some suburbs are moving. The little cash goes where it feels safe, as rates look liable to tumble. Yeah, I agree with that, Joe, absolutely. And it's, in fact, exactly what Chris Bates and I discussed today as well. You know, inner suburban houses in Sydney and Melbourne, prices are rising because there's limited supply and people are wanting to get into those areas, either to knock them down and rebuild on the land, or indeed to renovate or to buy relatively new. Limited supply, prices go up. But if you come further out, if you look at the new land packages, if you look at some of the outer suburban areas and go out into the the acres and acres of land which is now being built, and you filmed, of course, a lot of that in New Zealand, Joe, and we've shown this in Australia too. There we've got thousands and thousands and thousands of properties, all of which are the same, all of which are constructed to a relatively low level of quality, and all of which are pretty, carbon copy of the one down the road. Those are now being sold for less than what they were being sold for 18 months, 2 years ago. And that's putting downward pressure on the markets. We also know that land values are falling too in some of these outer suburban areas. So you have to look granularly, right? Another example is you look at the high-rise sector. People who are in the high-rise sector in buildings where there are faults and cracks, don't know what to do, right? Do they keep quiet about it and hope that nobody notices, or do they actually raise it and hope they get fixed? If you're in Mascot or somewhere else, you're being asked for $60,000 to help pay for the unit to be fixed up. That's a big number. That's going to have a significant downward pressure on the value of those types of properties. So again, you can't uniformly assume everything's going to go up or everything's going to go down. And you have to be very granular. It's really important. And flight to quality is absolutely right. As Chris will say again when I put the show up tomorrow, buying the best suburbs, away from the main roads, areas where there are the best schools, those are the ones that hold much more value and will go up, whereas many other locations less so. Okay, let's pop down the list. Adrian, thank you for that. Really appreciate your contribution. Now, let me just cover the hyperinflation question. So hyperinflation is essentially when more money is printed, right, to go after the same assets. And what that basically does, it puts up the value of everything but the real value of nothing. And that is the risk that we can potentially see. And if you look at Argentina, great example, very high interest rates there. money being devalued, international exchange controls in place, all of those things can follow. It's definitely one of the scenarios. It's not the only scenario, and if you want to really get into detail with regard to all the different scenarios and how they play out, look at John Adams' work on his different scenarios, because he takes these into much more detail than I can on the show tonight to show that the outcome could be hyperinflation, it could be very low inflation, it could be devaluation. There's a whole bunch of things there, right? And of course, remember that there's a relationship between what happens to interest rates and the exchange rate. And one of the things that we're quite concerned about is the RBA seems quite willing to let the exchange rate drop. And, it was down at 67. It's come up a little bit now because the US dollar is a bit weaker. But the chances are that we'll see the US dollar strengthen against the Aussie dollar. We'll see our dollar go down. And in some of my modelling, we're closer to 50 rather than a 60. And if that happens, of course, inflation is imported. That includes everything from petroleum if it comes in, cost of goods coming in, and that can flow through to higher costs. Now, what's fascinating about that is actually the Reserve Bank probably doesn't worry about that too much, because they are concerned about trying to keep the inflation target around the 2 to 3%. And in a way, a bit of inflation, importing it from international sources by dropping the exchange rate, could help them. But that begs the question as to whether, in fact, the targeting and monetary stance and policy is right. My own view is I think we have to query whether, in fact, this whole idea of inflation targeting at 2 to 3% is right. And I may come back to that to answer a later question. Okay, what else have we got? Yeah, so one of the interesting questions that people have been asking here is the cash ban. I'm just going to talk about that now because I think it's just worth highlighting. We've done a lot of work over the last month or two about the cash ban and about the $10,000. Now, one of the interesting questions there is, of course, is what already exists. Well, there is the AUSTRAC requirement to report large cash transactions, so that already exists. But the thing that we've been concerned about is if the cash ban comes in the way it's been framed, then it essentially will make it illegal to do something which is legal today. And that is, to me, a concern. And in addition, the reason being given by the government, that's all to do with the black economy, right, is in the context of a black economy getting smaller, not bigger, being relatively small to start with. And the true black economy is not down amongst small businesses paying without a receipt. It's at the big end of town. It's big businesses. It's those who actually are getting advice from the the accounting firms to be able to actually structure their finances to not pay the tax that perhaps they should be paying. So in a way, there's a deflection going on. So we're being asked to look at this from a black economy standpoint. But the truth is that the real reason why this is important is because if rates go negative, as chances are they will, as I've shown you in my scenarios, particularly if things get more hairy, that's not going to work unless they can control the movements of cash. Because what the IMF's paper says quite clearly is that if you want to go negative, and if people can take money out of the bank and take it out of the banking system and continue to use it, you will be ineffective in forcing them to consume and forcing them to spend. That's ultimately what this is about. So low interest rates are about making savers squeal to the point where there's no point in saving and forcing them to spend, and getting loans and using those loans to buy more things, right? That's what this is about. That's what the monetary strategy is about. And the point to make there is that this is a continuation of the 2007-8 global financial crisis. Nothing was ever fixed. The QE that was actually done then in the US and other Northern Hemisphere areas has continued. The size of the debt's got bigger and bigger, as I reported yesterday in one of my posts. And we have learnt nothing. And yet we're running the same story again. We're going deeper and deeper and deeper into debt. We're going to lower and lower rates. And the cash ban is a critical element in that strategy. So if the cash ban is not allowed to come in, then essentially what it means is that there is, no way that they can actually execute negative rates and get the outcome that they want. By the way, I don't think negative interest rates work. If you look at Japan, if you look at some of the Scandinavian countries where they've been doing this, and even where they've pretty much banned cash in the Scandinavian countries, they have not solved their fundamental economic issues. So the problem I have is that the monetary strategies that the central banks are advocating, and the IMF and the BIS and other people too, they're all taking us into a cul-de-sac. And unfortunately, I don't think that we're going to be able to dig our way out, but that doesn't mean that we shouldn't try. Hence the discussion today in our short post earlier on that the Liberal Nationals agreed to support the cash ban as proposed in the original draft legislation, despite the fact the legislation was only half formed in the consultation phase. They have not posted the 4,000 submissions from around the place. So Treasury has chosen just to mute that, right? And the chances are that the legislation will be brought into Parliament, could be even this week. So worth picking up the phone and making a fuss to your senators and to your members of Parliament if you believe, like I do, that human liberty is being curtailed and it's being effectively presented as one thing, but it's actually for some more important critical reasons from their point of view. But from our point of view, I think it's probably much more risky and not a good outcome. Okay, let's go back and see what else is going on. A lot of questions and comments going on in the chat. Good to see that. Okay, Joe says RBNZ has announced that the New Zealand dollar is the 10th most traded currency in the world by volume. How? It's the 53rd largest economy. Lots of playing on going in our money markets. Yeah, this is part of the BIS global reports on things like derivatives and currencies. In fact, the Reserve Bank published the same data here in Australia, and in fact the BIS published information for a lot of major economies around the world. One of the really interesting things, though, if I take derivatives as an example, they are now only disclosing the average daily volumes transacted. They are not disclosing the total value of derivatives outstanding or the total value of contracts outstanding. Now, they used to do that. Now, ask yourself the question, why is it that they are no longer reporting it? That's because they want to hide the big number. We know that the amount of derivatives in the system is massive. We know that many companies are using derivatives, but we know that the banks are using derivatives too for their own trading purposes. And they're taking their own positions. And of course, those banks are the very same banks who are writing mortgages and holding deposits. And so the risks in the system, because of the way that the derivatives and the other financial transactions, and that includes the currencies and everything else, that's all part of the same speculative medium that the banks are working in. It's all about generating profits out of those trading activities, but at the risk of the core banking that's going on. And that's one of the reasons why there's a lot of discussion about the Glass-Steagall separation, separating those sporty trading behaviours and activities from meat and potato banking, right? Because essentially, if I'm a depositor and I've got money with a bank, and that bank gets into difficulty because of its international trading position, or because the exchange rates move dramatically, or because the derivatives blow up, they are going to come knocking for my deposit to save those international banks. Have no doubt. So we have to find a way to try and separate meat and potato banking from the rest of the banking system. And that's why the Glass-Steagall separation is pretty critical. Now, there have been attempts in Australia to bring that into Parliament, so far unsuccessful. But it's important that we understand that the way that the banking system works at the moment, it's all rigged in favour of the big end of town. It's all rigged in terms of those transactions, all rigged in terms of being able to make money off making money off making money, and taking speculative positions and then taking them out. And I don't know whether you've seen this, but in fact there was a report today in Bloomberg that JP Morgan has been accused of manipulating the gold market. Of course, they're very active in the gold markets, but now effectively it looks as though those markets, and we've always suspected it, are also being manipulated. So there is no safe haven in terms of any of those markets, because essentially bankers are taking positions and bankers are manipulating to maximize profit at the expense, of course, of your average investor. Okay, Precious Girl says, is your guess full-blown MMT style policy comes in before current monetary policy exhausts itself completely or after serious collapse? It's a very good question. And thank you very much for the contribution, by the way, too. Look, I think that there's a split view amongst some politicians. A lot of people in political land are grasping on the MMT style. In other words, let's create some direct amounts of money by borrowing more. We can borrow at very low rates at the moment. Let's take that money and let's go do things. Give it to households, or give it by way of a universal income or something, or invest it in massive infrastructure. It's happening in the discussion in the US as well, particularly in the context of climate change, as well as defence and other things, and potentially here as well. The question is, will they go that way, or will they take interest rates lower and essentially muddle through first? My own sense here in Australia is it's unlikely that the government would agree to essentially borrow more until they've been able to prove that they've actually delivered the surplus. Remember that surplus that was promised before the election? So they are desperate, absolutely desperate, to be able to say, see, we've delivered a surplus. I have a feeling that the results to the end of June will come in just slightly negative. That's my sense. I think it'll be next year, in a year's time, that they'll then claim that they'll have the surplus. So my own feeling is any MMT activity, unless things really blow up, would probably be after June 2020. And that means that they're going to have to use monetary policy and take rates lower in the interim. They might do a little bit of more fiscal stimulus around the sides, but they're going to protect that surplus above anything else. My own view is that's probably bad strategy. I think there's probably a very strong argument to say we should be doing more now. But remember, the last stimulus, which was big when Rudd was in power, was as a result of an international financial crisis. There is no such international crisis today, and yet rates are lower, and people talk about doing more than back then. We live in a strange world. Okay. What else? Lachlan, thank you very much for your contribution. Really appreciate it, and helps us to make more contributions, more content. Okay, and Essays asks, what happens with university debts if we get hyperinflation? Thank you, Martin. You're a legend. Let's save this great country. Well, I agree about saving the country. Look, I came out to Australia 25 years ago now. And when I came out from the UK at the time, I thought it was an amazing country, as well as the scenery and the climate. The freedom and the enterprise that we saw here was pretty remarkable relative to the UK. I feel that it's been degraded in the last 25 years. And, I'm very, very passionate about trying to call out what Australia could be, because I think we have massive potential and massive opportunity if we actually go and get our act together. And yet we seem to be spiralling into a politicised environment where effectively nobody takes anything very seriously. It's all about scoring political points. And in the meantime, we're fiddling while Rome burns. And that's the concern I have. Now, you're right, hyperinflation could well reduce the value of existing debt. That's one reason why inflation is attractive to some people. But of course, it tends to devalue as well, and that's the problem. So it's a double-edged sword. But, massive opportunity, I think, to create an economy which is more vibrant, an economy which is definitely focused on creating more real value, not just recirculating that same dollar around faster. A lot of the jobs that are being created at the moment are in the healthcare sector, very important jobs in terms of the people they're looking after, but they're just moving the dollar around faster. It's not creating more value, and that's the problem that I see. It's what I discussed the other week on the ABC show. You may have seen it on Sunday evening, just over a week ago, with Stephen Long, where I said the problem is with the bedpan economy is that it doesn't actually create real value. We need to find a way of creating more value. So for me, that's part of the story. The other thing that I want to just highlight is that I think that the question of climate change and how we react to that, whether it's man-made or whether it isn't, personally I think it is man-made, but that's my own view based on the science and based on what I've read. But, things are changing. We know that the climate is changing, so we should be thinking much more proactively about the degree of adaptation and change that's required. Again, there is opportunity if we did but see it, but we seem to be just not wanting to have those critical conversations. And the other factor I want to highlight is the fundamental driver and assumption of continued growth is one that I'm quite concerned about, because I actually think that there's a big question as to whether, in fact, it is feasible to continue to grow like we've been used to growing. How many planets have we got? One. How many planets do we need if we're going to actually grow the way that we're currently growing? About 2.5, I think, last time I looked. We're out of planet, right? And that's the problem. So we've got to find a different formulation. And I think that means a different formulation for measuring the success of the economy. I think it means also a different way of thinking about investment plans for the future. And frankly, a very different set of conversation. That's not something that anybody in the political sphere that I've seen wants to talk about. And yet, I think that should be also on the agenda. Sorry, got a bit preachy there, but I feel passionately about these things. We just go down the list. Okay, Stephen asks, is there a lower limit to how low the Australian dollar to the US dollar could go? Well, the short answer is there is no theoretical limit insofar that we have an exchange rate that is floating. And that means that it's a shock absorber, right? So it can actually absorb some of the pressures by taking the exchange rate lower, which means that effectively we make our exports cheaper, so we can perhaps sell more, and our imports more expensive, which imports inflation. But of course, there is a point below which effectively the Aussie dollar becomes worthless, right? At some point, investors potentially might say, I'm not sure this is actually worth what you're saying it's worth, right? And that's at the point where the confidence in the dollar goes away. And that's the critical turning point. I don't know whether you saw, but we did a post on the Interest of the People channel with John Adams, where we were speaking to somebody, he'd written a book called Code Red, about this challenge of the exchange rate. If it slides, there is a point at which it becomes effectively junk. And at that point, international investment stops. At that point, essentially, our economy is shot because we're so reliant on international funding for what we do here. So there is a lower bounds, but it's not a specific rate. It's sort of a trajectory, right? And it's about the risks. At what point do external investors think that our economy is a bit bust? And that's one reason why politicians, the Reserve Bank and other regulators keep talking up this economy, because of course they want to encourage that international investment and they want to try and make sure that people are putting money into Australia, because without it, believe me, our economy could not function. Jeff is asking, this is a question for Joe, do you have any insight or data on the UK's likely property trajectory post-Brexit, specifically home countries? Well, it's an interesting one. I'll give you my thought. Joe might want to put his comment on the channel, or we might do it another post. We did one some time ago where we actually spoke about the UK, and Joe spoke about, is Boris going to be blamed, right? Because the theory I think we've got is that there are potentially downside issues relating to property in the UK, and what happens around Brexit could well drive property prices a bit lower. But then, of course, the demand in the southeastern part of the country is a lot stronger than it is in other places. But if you look in the UK, prices have not been doing that well relatively recently. And certainly in the southwest of England and in northern England, prices are significantly down. So it'll be an interesting challenge. And of course, the fundamental question is, how does Brexit end up? You know, we're going to end up with essentially leaving without any sort of agreement, staying in, or some point in between. So it's hard to predict. But in some scenarios, I think property prices in southeastern England could definitely fall quite considerably. This is from Wiser3754. Thank you very much for your contribution. I read in the Australian that 21,000 skilled workers are needed for a host of new mines. Is that indicative of a new mining boom? Well, there is definitely a resurgence of mining investment at the moment. That's absolutely true. But you've got to keep it as a sense of proportion, right? Because if you look at the total number of people working in the mining sector, it's always been a very, very low number. And of course, it's in particular locations. Now, there's a little bit of an uptick in some areas of Western Australia, thanks to the fact that the mining boom has come up off its bottom a little bit. But the question you've got to ask yourself is, who's going to buy what we sell, right? Because China, of course, has been our main customer. It's interesting to note that the iron ore price was up at 120 US. It's now down to 90. And that's partly because the Vale Brazil issue is starting to get solved, and other miners in other locations are also now starting to mine iron ore too. So the supply side is definitely increasing. The demand side is not necessarily rising. China, of course, is still importing, but is maybe not importing as much. And if China goes off the boil, demand could go off. So I think it's going to be quite interesting to sort of see to what extent this really does turn into another mining boom. Obviously, there are people talking it up. There are also other people like myself who think, well, let's get a sense of proportion here. In terms of the total number of people employed, very low. A lot of miners are paid large amounts of money, so they could actually start buying property again. And there are some really, really low-priced properties out in those mining areas, because prices have dropped in some cases 80% from where they were 5 to 8 years ago. But we'll see. I think it's probably not going to play out like this time. Okay, what else have we got? Okay, so Indiana Jones says, can you keep your savings in a mortgage with a REIT? Okay, now this is one of the questions I got before as well. So let's go through the deposit risks and the bail-in of deposits, and also the deposit insurance scheme, because these two things are of course linked. Let me start first with the deposit insurance scheme. So there is a depositors insurance scheme in Australia. It's worth up to $250,000 per relationship and per set of accounts. So you've got to be careful here, because if you have money with, for example, St George and Westpac, they are single. It's a single count because they are one entity. So you've got to be careful about thinking about that. And if you have multiple accounts, the total is still $250K. Now, that is a guarantee that is in theory made by the government. It does not exist at the moment. It has to be activated by the government when a bank has failed. And in fact, there are some tests running at the moment between APRA and the banks to see how this could actually work in practice if there was a bank failure. So this is, not just theoretical, this is real, right? So the idea is, if a bank falls over, the depositors would actually be able to be protected up to $250K in total. But there's another catch. There's also a 20 billion limit per institution. So if you were the big institution, you might find that the amount of deposits would be higher than that, so you might not get all of it back. Now that's, not totally clear and lots of questions, but that's roughly where it is. That's in a gone concern. But there's also a thing called bail-in. A bail-in is essentially an arrangement to help a bank before it fails. And New Zealand is the best example of bail-in. They've got their open banking resolution processes very clearly articulated in New Zealand. And what that says is, if a bank gets into difficulty, then they will grab types of assets to be able to support the bank, convert them into equity, and essentially allow the bank to continue to trade. And as part of that, deposits in New Zealand are definitely grabbable. as well as convertible bonds and other things. Now, in Australia, it's much less clear because there was a bill pushed through the back door, a bit like the cash ban, without real discussion, which basically says in a bail-in situation, various asset classes could be grabbed, and it's deliberately vague around deposits. Now, some people in Parliament and amongst that process, no, there's no intention of bailing in deposits, despite the fact that there are bail-in rules in New Zealand, Canada and a few other places around the world, and it's been articulated by some of the central organisations like the IMF and the BIS and all these, the World Bank, all those organisations, that this is part of the resolution strategy for banks to stop governments having to rescue a bank in difficulty. And as I said earlier on, almost certainly banks will be rescued one way or the other if they get into difficulty rather than be allowed to fail. So then the question is, okay, if I've got money in a deposit account and I've got a mortgage and I've got an offset relationship between the two, either formally or informally, what happens? Could they nick the deposit and leave me with the mortgage? Or would the two be offset first? And that's a very complicated and difficult question. There is no simple answer to that question in Australia because, firstly, a bank has what's called right of set-off, so they have the ability to be able to write one off against the other before they start. So my theory is that right of set-off would take priority, but there is no guarantee on that. In fact, there could be a scenario where, in fact, they nick the deposit and you've still got the loan, but I suspect right of set-off will take priority. This needs clarifying, right? As does the question as to whether, in fact, deposits are or are not bailable in Australia. That's one of the reasons why we're lobbying for changes to that regulation to make it absolutely clear that bank deposits are not to be bailed in. But if they were to be clearly not bailed in, that would go opposite to the IMF, opposite to New Zealand, and opposite to a number of other countries around the world. So it's important that people understand that at the moment it's a very, very unclear state of play in Australia. My own strategy has been to spread the risks across multiple organisations. So I've got small amounts of money in multiple banks rather than all in one bank. I've avoided the big four because of their derivatives exposure. As I discussed earlier on, they're very, very exposed to international market movements and they could easily get caught because of that and then need to grab deposits. So in a way, smaller organisations, credit unions, building societies are perhaps lower risk. Spread it around. But the question with regard to offset is very unclear. The other thing I want to tell you is that if you look at your terms and conditions, almost certainly in the last few months they'll have changed them to make it easier to react to any government directive without notice. Pretty much all banks in Australia have now changed their terms and conditions. So if you've not read your terms and conditions recently, it's worth doing because it makes it absolutely clear that if, for example, APRA said, grab your deposits to be able to actually save the bank would then say, well, your terms and conditions had given us ability to do that. Didn't used to have that, they do now. So read your terms and conditions, spread the risks, and you might want to ask your bank the theoretical question about right of offset and set off between an offset account and deposit account. I suspect you won't get a clear answer because I've asked a number of organisations and they've all been very dodgy about their reply, and I think deliberately so. So I'm sorry I can't give you a more definitive answer. Okay, Indiana Jones says, do you own multiple properties? No, I don't. I own the property I live in. I don't have a mortgage on it. And the reason is that over the years, I've always had the view that property is less of a good investment for me than otherwise. Few reasons. One is prices go up, but prices come down. The second is that it's very hard to deal with an asset if, for example, you want to move around the place. I didn't want to have a large portfolio of assets in case I went back to the UK or did other things like that. I don't believe that many people make much money on property investments unless there's significant capital growth. The capital growth that we saw over the last 20 years was a unique one-off situation thanks to deregulation of the financial system, thanks to massive overlending and all those things. I don't think we're going to see that amount of capital growth again. And frankly, I wanted more control and more agility and flexibility. So what I've done is basically use my self-managed superannuation fund to essentially look after my assets that way. But no, I only have one property. Opposed Deception says, no need for bail-in, bail-out. Central bank can recapitalise banks just the same as Japan in 1947 and the USA in 2008. Well, they could, but the money has to come from somewhere, right? Where does that money come from? It comes from government debt. And what the regulators around the world and what the banks around the world and governments around the world are trying to do is to avoid creating more debt to bail out banks, right? That's the problem, right? Now, if you think about it, if a government uses government money to rescue a bank, that's taxpayers' money. So it's, average punter's money that ultimately bails out the bank. If the bank is saved by bailing in deposits, that's depositors' money, i.e., your taxpayer again, the household, right? And if in a gone concern, the government actually does rescue those deposits, guess where that money comes from? Well, it comes back around again, and ultimately taxpayers pay. So here's the problem. At the end of the day, however the banking system blows up, it will always come back to households. There is no other last resort, right? It's not like the government can suddenly magically create some money out of thin air and say, see, no impact. There is an impact. Yeah, okay, you can do MMT type things and you can borrow at very low interest rates. Money still has to be paid back ultimately. So that's the problem. The buck stops ultimately with households. And yet, banks, when they make profits, pass those profits to their shareholders, and that's always the issue. So effectively, you socialise the losses and you privatise the profits. And that's the fundamental flaw in the way that the banking system currently works today. And yet that is precisely the way that central banks and the IMF and all those other central organisations all think about banking. That's the fatal flaw. Okay, let's have a look here. What's this one? Do you still expect difficulty in rolling over interest-only loans? Have several family friends who have multiple properties on IO loans. Some are not getting rollover. Yep, indeed. I've said several times that the pinch point on interest-only loans is yet to come, right? So there is some who've rolled now, but more are waiting to roll ahead, and it's becoming quite obvious now that some of those will not be able to roll to an interest-only loan. They'll have to go to principal interest or even sell the property. There's about 120 billion of interest-only loans due this year, next year, and the year after. Of around 1/3 of that will not be rolled. That's an issue. And that's enough of an issue to be a significant dampener. Some of those will have to sell. Some of those may go to principal and interest. But remember that the average repayment goes up if you do that. So interest-only loans, absolutely. And I did a post about 2 or 3 weeks ago where I discussed that in more detail. Yes, Opposed Deception says, money needs to not be created as debt. See Prof. Richard Werner. Yeah, no, I'm aware of Werner's idea. So it's not a magic pudding, though. I don't believe that it is a magic pudding. If you create money, which effectively becomes, value in some form, it still has an impact on the economy. It still has an impact on the banking system and those things. There is no free lunch, I'm afraid. There are lots of people arguing for these different strategies, but so many of them are flawed because of that. It's my own view. I haven't seen yet a solution that I think really gets to the heart of the situation. Of course, the bigger the debt that we've got to start with, remember that the amount of debt in the system today is a lot bigger than it was post the GFC. Again, look at my post yesterday. This still is a a degree of debt that has to be dealt with one way or the other. And taking rates lower is part of the, official solution. Won't be sufficient in my view. So yeah, I'm less convinced of Werner's ideas on that particular point. Okay, what else have we got? Okay, so now interesting debate going on there about gold and silver, and there are. Let me pick up one of the questions that I've got beforehand, which has been asked many times. So basically, it goes like this: look, I've got some money. I've held on to this money for some time, and I'm trying to work out how to protect my particular situation in this time of uncertainty. What's the best strategy? Now, there is no simple answer to that question. I must tell you. The fact of the matter is that there is no sure bets, right? So some people will say, well, maybe property or land is the way to go because ultimately it's physical and it won't sort of disappear into the ether, right? And we might look at Tasmania or somewhere like that where there's still reasonable value there. Some people are doing that, and there is some logic to that. But of course, the issue is that there's a risk of losing capital, particularly if values fall. And we know that, for example, in some of southwestern cities now, the average plot of land is half what it was 2 years ago. So it's not a one-way street with regard to buying property, and yet some people are doing that. Other people are saying, well, maybe I should buy gold or silver because at least I've got some greater security with regard to the value of what I hold. And that's partly true. But again, the point is gold and silver are still traded in those same financial markets. As I mentioned earlier on with JP Morgan, there is still fraud going on in those markets. The markets are still relatively fixed. And therefore, they are not as risk-free as many people would say. And you've all got additional risks, of course, of storing it. Where do you store it? And when you want to use it, how do you exchange it for something that's more fungible? Because it's, you can't go down to Woolworths and buy a packet of chips with a bar of gold. It just doesn't work like that, right? So gold and silver, well, maybe not. Other people will say crypto. Well, of course, crypto, it's the way to go, and it's grown dramatically with the price. Look at Bitcoin. Yeah, maybe, but there's nothing much supporting it. And as I've said several times, prices can go up, prices can go down. And, you don't know what the value of Bitcoin is at any one point in time. And they might ultimately be a reasonably good bet, but it's a bet because nobody knows, right? So then do you go, well, do I put it in the bank? Do I put the money in the bank and get, returns I can? Well, you can, but returns on term deposits are going down thanks to these low interest rates, and rates will go lower. So that is going to be, a problem in terms of if you need capital returns. And, you start going down the list of stocks and shares. Well, yeah, they can go up, but they can go down. The point I'm trying to make here is there is no silver bullet, simple solution that's completely waterproof and watertight in terms of asset protection. I'm afraid to say, none of them. They've all got their risks attached to them, some more, some less. People will make their own decisions about which is more important or less important for them. And what I've done is, have formed a view based on my own scenarios. I still think that the banking system is not completely broken, and therefore, as I said earlier on, I've shared the risks by using multiple organisations, but I want the flexibility at the moment. So I went to cash about 2 years ago. I'm still in cash. I will stay in cash for some time because I think other alternatives are still as risky or more risky. Now, that's just my own view. Other people will have different views. So there is no silver or gold or crypto bullet to the question of asset protection, I'm afraid. And by the way, spreading the risks sometimes is quite a good idea too, rather than putting everything into one asset class. Okay. How are we doing for time? 9:18. Oh, we're chuntering through. Okay. Inside straight. Martin, if house prices are primarily driven by credit availability, does this mean that 0% or negative rates will act as a price ceiling? Now, well, you're talking about an interest rate versus credit availability, right? Even at low interest rates or negative interest rates, banks will still be desperate to lend more credit. because essentially banks are totally reliant on the rate of change of credit growth, in other words, increasing the amount of credit in the system to be able to drive profitability, they get bigger, and also to drive margin. The way it works is in negative interest rate scenario is that the central banks would essentially hold negative rate assets of the banks and allow them to effectively use those. If they don't use them, the banks have to pay. So there will be very low rate funding available through quantitative easing or some other mechanism, right, which will force the banks to lend more. As the banks lend more, that will then lift the amount of credit in the system, lift house prices as a result of that, and therefore zero interest rates or below translates to house price growth, probably, for a period at least. If in fact people don't take those loans, and if people say, no, too risky, not confident enough, and credit availability then tapers off because people just don't want to take it, so the rate of change drops, that's the point at when you start to see home prices fall again. And if you look at the trends carefully, the rate of change of credit was decaying up until about July, and now it's started to pick up again. And that's one of the reasons why I'm saying that in the short term, we are going to see home prices higher because the rate of change of credit is rising. But I still think at the moment that's a relatively temporary phenomenon, and it could well turn the other way. The question is when. I still think 2020 is going to be the critical year, and that goes back to what I said earlier on about how much interference we get from central banks and from the international situation as to what plays out. Okay. So Brad says, do you think Phil Lowe is wary of dropping interest rates too quickly, given his previous publishing on the effect of low interest rates on asset prices? Oh, what a wonderful question. Yeah, there's a theory and practice going on here, right? So, Mr. Lowe over the years has written a number of papers, and he's basically been quite, I think, conservative and, basically saying be careful about these things. And yet now he's faced with the situation that because the politicians are sitting on their hands doing nothing, and they're all looking on to him to basically say, fix the economy, he's now being forced into a situation where effectively he may have to take rates lower than he'd want. He's also, of course, not alone insofar that central bankers around the world are all driving things the same way. And in a way, I think this is a wonderful illustration of groupthink amongst central bankers, right? Some people have said, you've got this cabal and they all sort of, are plotting. No, I don't think they are. I think they're all basing their thinking on the same ideas, the same philosophy and same approach. And so they come out with the same answers. And we saw Germany cut their cash rate from 0.4 negative to 0.5 negative. And Germany also announced that they're going to tier the interest rate charges for the banks. So that effectively, as rates go more negative, just need a drink, excuse me. As rates go negative, essentially it allows them to lend more. The banks around the world, central bankers around the world, are all smoking the same dope on this. That's the problem. There is no independent thinking. The closest bit of independent thinking that I've seen recently was when the guy at the Bank of England, when he was over in the US, suggested that maybe they should decouple the US dollar and essentially go for a crypto alternative, right? Really interesting idea. And, there are all sorts of questions of that, but that was the first time that I've seen anybody in central banking land essentially float an alternative strategy other than the ones that are there currently. Motorhead Benny wonders, so are you saying a vegetable patch is the best investment? Well, there is an argument. And it goes back to, there are people out there talking about what's called the Great Reset, right? Which essentially is to say, this is going to muddle on for a bit further, but essentially it'll cave in on itself because the amount of debt is unsustainable, all the risks are being taken by households, the banks are unmanageable, uncontrollable, corporates are zombies, and essentially it's all going to come home to roost. Now, I think there's a lot of truth in that. The question is, will that really go out to the point of some sort of reset, and will they bring in then an alternative, currency base, all that sort of stuff. Now, again, I'm not sure that that's all planned. I'm not sure that there's sort of one point where somebody's calling all the shots, right? But the fact of the matter is that in a time of uncertainty, relative priorities change. Food, drink, self-sustainability, those things can become quite more important. And if we go back to the Great Depression, it was actually people in the country who actually got off a lot better than people in the city, because they could grow their own food, and they could, basically barter from things that they built or grew, and were able to survive. It was the people in the cities who had the worst end of things. And I suspect that the same could be said again. We've become so reliant on a very connected international financial system and a very connected set of trades and all those things, that it's going to be quite interesting to see whether, in fact, this disruption that I think could well happen ahead has such a significant impact that it changes a lot of lifestyle locally. Can we guarantee supply of fuel? Can we guarantee supply of water, power, food? I mean, those are deep questions, right? And there are people who actually are suggesting that at some point this is going to come apart. Now, I'm not sure I agree with them, but we should be watching for the early warning signs. Okay. Now, I'm just going to go back 9:25, so I'm pretty much coming to the end, I think, today. Yes, Oz Gov advice during Depression was to grow your own food. 1 garden bed per child minimum. Yep, I know. In fact, my father, who lived in the UK and lived through the Second World War, talked to me about that too, that they actually had their own gardens and they were actually growing a lot of their own stuff. Simple food, but they survived quite well. Okay. Michael says, you need 4 things to survive: roof over your head, food on the table, clothes on their back, and a smartphone in their hand. Yeah. Okay. What happens when the network stops? Right. That's one of the interesting questions. Right. One of the reasons why I think the cash ban is so suspect is what happens if the networks go down and you can't connect, and and you need to go back to a fallback. When there was, I don't know whether you recall this, but a few months ago there was a situation where the Telstra network went down, all the payment systems stopped locally down here. And I went to try and get a coffee and a newspaper. I had cash. I was able to buy those things. But a couple of the places I went into didn't actually take cash. They'd forgotten how to handle cash. And so they couldn't trade. Just a simple illustration of how dependent we've become on this wonderful technology, right? I think a fallback is not a bad idea. Okay. Well, what I'm going to do now is I'm just going to go back to the end of my presentation and just do a few closing remarks, and then I'll just come back and close off shortly. So just want to say that if you feel that you'd like to help support our work, we do have a Patreon channel, and we've actually been able to add a few more people to that channel in recent times. We've actually, in the last month, put up another 10 people. So thank you very much if you're one of those Patreon supporters. You get access to exclusive access to material and a whole bunch of other stuff. And, have a look at that. All my posts are there pretty much, and you can access them all conveniently as well. Or if you want to just make a one-off donation, you can do that via PayPal. There's a link to my PayPal account there. And we do have some people who do that. Thank you very much for that support. Any money that we get goes directly back into creating more content. We don't make a profit on any of this. This is purely just cover the costs of creating the content and all the other activities around it that's required to be able to make it work on here and also on the IOTP channel. Or indeed Bitcoin, because somebody asked for me to be able to receive Bitcoin, so I have. There's a QR code there. If you want to use Bitcoin, then feel free. Just a few top hits this month. There was an important post we did called the Property Buying and Selling Discontinuity. That looks at my surveys and looking at different types of households and what they're thinking of doing over the next 12 months. That is what's driving a lot of my modelling. The other one to look at is getting to grips with how money works, and that's where we talk about credit creation and the fact that fractional reserve banking is not the true story as to how banking works, and we talk about credit creation in the banks and why that's the critical thing to get your head around. Very, very subversive when it comes to central bankers, but very important to understand. The AFR exposes Australia's dirty power structure. That was one on the Interest of the People channel. That's John Adams and myself talking about the fundamental issues around how power works in Australia, and specifically what the AFR did. The two episodes basically attacking myself and John Adams and Robbie and a few other people. I just want to say thank you to the thousands and thousands and thousands of messages of support that I've got after those things were put up. It was amazing to get the degree of support that I got, and I want to say thank you to each of you. That was tremendous. Joe Wilkes and I discussed, will Boris be blamed? I mentioned that earlier on. Very interesting post about the UK. There's quite a few other posts up with Joe on New Zealand, and there's more planned there, so look out for that. And also, you might have not seen The Long View, which is on the ABC TV. That was the segment I mentioned earlier on, where Stephen Long, ex-economic correspondent at the ABC, and I discussed some of the broader issues around the economy and how likely it is that things are going to go wrong, and debt and all those things, and the bad pound economy. Very interesting short section that really, I think, boils it back quite nicely. So that's available on the DFA channel if you've not seen that. As of yesterday, there are 980 different posts on the DFA channel. You can use the search facility to find things. So, for example, you want to look up credit creation or derivatives. Just search in the derivatives. Just search in the search box on YouTube. It'll come up with all of the ones in that particular area. So that's one way of navigating them. So that's it, really. I just want to come back finally to the question to see whether there's any last points anybody desperately wants to make. I think we've had a good run tonight. I have not been able to answer every question that people asked of me. What I will do is I'll make a couple of other posts over the next few days to cover some of those more specific things. The trouble is I had a number of very specific questions that I was asked that really was less useful to a more general conversation. But hopefully I've given you a bit of a flavour of some of the things that I think are important, and indeed some of the issues that I think are, they're driving some of the behaviours that we're seeing at the moment. We live in quite an uncertain time at the moment, but, let me try and sort of put this in some degree of perspective. I'm not somebody who is, saying the whole world's going to fall about tomorrow, right? There are a series of risks locally and internationally. I'm more concerned with some of the behaviours that we're seeing locally amongst our politicians, and those are some of the things that John Adams and I discuss on the IOTP channel. I think there are some risks in the system at the moment which are probably more extended than people generally realise. I think that people need to be very careful about buying property at the moment. There is a bit of a rise in some property prices in some places, but there is a risk of a bull trap. And the fundamentals in terms of the economy, think of things like employment, think of things like the lack of wages growth, think of things like the GDP per capita going backwards. All of those factors are real. And the reason that the economy is no weaker than it is was because we had a very high iron ore price, and the government's been spending big to try and support the economy. These are not fundamentally, critically positive moves in the economy. And what I'm asking for is for government to wake up and smell the roses and begin to think more creatively and more strategically about the future. And for individuals, what I'm saying to them is, when you do your calculations and think about what you can afford, for example, or what you should do next, be relatively conservative at the moment, because there are so many risks in the system. And just because a bank says, yeah, you can have this mortgage, think about whether that really is a sensible thing in the current environment, particularly, of course, because a bank is only thinking about, can the risks be covered by the sale of property? It's not the same thing as thinking about what might be the best interests of a particular household or consumer. So I think that's just sort of a passing shot, which I keep coming back to, because the more that I get into this work, the more I believe that the social consequences of what's going on at the moment are the things that are most worrying. And over the next few weeks, we're going to talk further about the social consequences. Look, we've looked over in Western Australia at some of the things that are going on there. We're seeing somewhat similar signs in some other locations now where stress is rising, and that translates into more domestic violence and more health issues, those things. I'm concerned about those social issues, not just the economic ones, not just the central banking ones. And the thing that I'm worried about is that ultimately central bankers seem to only fixate on these high-level theoretical discussions and, pull the levers and everything will be fine. Reality, unfortunately, bites, and reality hits real households in real situations. And that's what I want to try and focus on now as we take the DFA channel forward. So thank you for your time tonight. I hope you found that a useful session. Thank you very much for all your comments and for your suggestions and ideas there. As always, many more conversations we could have had, but it's going to be always a question of doing the best I can with the time I've got. I want to say thank you for all of those who super chatted and enabled me to just talk for a little bit longer and to help fund the channel. Thank you for your support there. Thank you for all of your comments, all of your questions. If you've got ideas for things you'd like me to see, like me to feature in the future, feel free to drop me a note on that. And many of you are in regular contact with ideas or links or other suggestions and comments, and appreciate each of those. I do try to acknowledge them all, but it is sometimes getting quite hard because there are just so many that come in. So we had several hundred over the last couple of days. So thank you for your time today. Hope you found this a useful post, a useful conversation, and I'll look forward to seeing you in a month's time. Things will be different, I'm sure, by then, but I look forward to it. It's Martin North from Digital Finance Analytics. Take care and see you next time.